Well, if you have a look at the daily chart of the Nasdaq, we've got a breakout on our hands. But can it last? That's the question we're asking today. We've got US banks, which I continue to believe are central to the focus of the market, trading in a fairly tight range. And the feedback loop into interest rate pricing is very real. We're still seeing the market expecting a fairly aggressive rate cutting cycle to start from September from the Federal Reserve. And we look ahead at the US dollar, where we're seeing a very, very tight range indeed. But which way will it blow? That's the situation that Blake and I discuss on the trade-off today. And of course, we've got the Bank of England meeting ahead of us as well. So we're looking at sterling flows. This is the trade-off. Well, hi there, I'm Chris Weston from Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. We've got a lot to discuss. Even though volatility is pretty low in these markets, there's a lot of landmines that we need to navigate, and actually trading structures that we need to put in front to sort of tackle the market environment we're seeing. When there's low volatility in markets, we can change and we can adapt to those situations and look to profit from those. It's not all about momentum. It's not all about trend. Sometimes mean reversion works well, and that's what we're seeing in this market. So I'm going to bring Mr. Blake Morrow into the program. Blake, how goes it?
I'm doing great, Chris. Good to see you. Happy midweek.
Happy midweek indeed. It all feels like another day to me, but to be honest, always smiling. We're moving on. We've got a lot to discuss today. Volatility is pretty low. It's one of those things where you're sitting there going, you know what? I'm looking at the debt ceiling. We know how it ends, but it'd be nice to have a little bit of volatility. It's going to be tough for you Americans when, obviously getting through that, but it'd be nice to have a little bit of volatility, wouldn't it?
It would be, everything's tight, but look, it's the calm before the storm. I know that phrase is used a lot to describe the markets, but I truly believe we are really poised to make a big move one way or the other. And I think we need to all be prepared for it. And that's why these setups that we're going to bring you today, I think are going to be very important moving forward.
We trade our market environment. We need to recognize the market environment, and our strategy is deployed in that market environment, whether it's range-bound markets, trending markets, range expansion. All those factors matter, and so you've got to know that market environment. And I think that's where we can offer some value in today's market. So let's go straight into topical fundo, and let's look at the big macro thematics, the talking points that are present at every barbecue. I want to talk about equity markets, Blake. We have seen the breakout in the Nasdaq. I'm going to talk about that in one of the setups there. But it's all tech at the moment. If you have a look at the S&P, we're not seeing that same love. We still need to break through 4,200 on the S&P futures, 4,160 or so in the cash market. The Russell still can't really get too much of a leg up because it's got such a heavy weighting towards banks and financials at the moment. It's still really not. There's not many of the long-only community who are wanting to step in front of the banks, because what we're seeing with a lot of regional banks, of course, is they're trying to attract depositors, and they're doing, for some of them, actually doing a pretty good job. And to attract depositors, you need to give market rates. And that, of course, impacts their net interest margins. It lowers earnings. And, of course, you don't want to step into banks when you've got earnings risk. Okay, fine. Yeah, their credit risk is reduced to an extent, but their earnings risk is going down as they offer better rates for depositors. But that's the problem, is you've got to address that deposit situation. But I'm looking at the tech side of things at the moment. We can talk about concentrated breadth. We can talk about narrow leadership. But the Nasdaq seems to be firing. Where are you seeing the balance of risk in US equity markets or global equity markets more broadly?
Well, let's define risk. I think the market is very well. It's money changing hands. It is not. You're not seeing money fleeing market. Of course, everybody's getting out of the regional banks. You're going to talk about the banking index a little bit later, but that money is finding its way into the Nasdaq. So the constant reallocation. That's a good thing for the markets. I still think that we need to be following the S&P. I think you're right. 4,200 is the key. And all we need is like a, debt ceiling push off until September. Yeah. And we've got about 10 days to do it, don't we, Chris?
I think it's less than that, mate. I think it's about 7, including if you're in the time off that Biden has off to get this done until we get through June. I did notice on the debt ceiling that the Treasury cash balance now is about 185 billion. It took down about 30 billion. So those funds are getting depleted. What I will say, though, Blake, it's all the stress is in money markets, right? All the bills that mature in that June window, which makes a lot of sense. Why would you be buying on that situation? in case there was a situation where there was a deferred payment from the Treasury Department. But I will look at the options market, and while we're not seeing it in put call skews at the moment, we are seeing it in the absolute volatility structures. So normalized skew. So we're looking at slightly out of the money puts relative to the out of the money call volatility, and we normalize it for out of the money. We are seeing a lot of hedging playing through. So people don't want to sell they sell their core equity, but you're buying puts to try and hedge your downside in that situation as well. We're seeing a lot of people actually selling calls above the market, taking the income and then using that to buy puts out of the money for free, so they don't have to sell that. So at the moment, the equity market, while we're seeing such low realized volatility, I think people are hedging their portfolios rather than actually dumping and reducing their equity allocation as well. That may well change if we get closer towards that deadline and we get to a point where the Treasury run down their cash balances to a point where they may have to go through this term prioritisation. Everyone get used to that. Could be something that we're all talking about very closely when they have to make a choice as to which payments they make, whether it's cut back on defence, vet payments, Medicare, Medicaid, Social Security, potentially even further down the line, some of its bond obligations as well. But we're not at that point, and we're not trading that. But I will say that bill market very stressed.
Us veterans are tough. Just cut those benefits first.
That's
just
right. I mean, to be honest, I think there is. It's obviously very political. If they get to a point, I'm not saying it's going to happen, but if they get to a point, what do they choose to cut back? Well, I think the big one. Obviously got a lot of time for the vets out there, but I think the one that they will defend above everything else, obviously, is the bond obligations, and we've heard Biden saying that he may look at the 14th Amendment, which every Republican's going to be taking him Supreme Court. But I think it's the Social Security, which is the big one that they want. 58 million Americans are on Social Security, and if they didn't get their welfare check on that week, I think that could be a big impact on consumer confidence and business confidence. So that's something we are looking at. If that happened, and bear in mind, Blake, I mean, first week, if we get down to a cash balance at Treasury of $50 billion, there's an $80 billion payment going out to Social Security and Medicare, which they might not have the money to pay. So that could be a big volatility event in itself. I mean, they get all their money on the 15th.
It can be, and it's interesting to see Janet Yellen trying to get ahead of everything this week. So stand by, guys and gals. Next week's going to be a doozy. I have a feeling. I don't think these talks are going anywhere right now, and I know we need to move along. But yeah, I think volatility is going to increase going into this next week. So stand by, and with the VIX implied volatility sitting at where are we at? 16, 17. It's hard to be short equities right now, but I'd be watching that pretty carefully. Hey, today was an important day, Chris, that we had CPI and we had consumer price index come out. The number wasn't far off expectations. Market sold off a little bit. We saw a rally back, but obviously the S&P closed in the green. But tomorrow we have our producer prices, and this is going to be an important number. I know a lot of people kind of gloss over and they roll their eyes at the PPI. But you have to imagine the PPI number. First of all, last month, I think we missed the mark by 0.5%. If I'm like 0.5%, I believe, if I'm not mistaken. And we're expecting a bounce back this month, but how much? And the reason why it's important, when you take producers, and my wife's in her business, and I understand how she marks up things based on her prices. She hasn't wanted to push a lot of those costs over to the consumer standpoint. So she's been eating a lot of those costs. But how long can companies do that? And that's why this input of the producer prices is going to be pretty big. If that number stays relatively strong and we bounce back even more aggressively than we have, at what point do producers really start passing all those pressures down to the consumer? That's why I think the PPI tomorrow might actually be a bigger mover than today's CPI that came in line. It's easy to say in hindsight, obviously, but I do believe that PPI kind of leads us to where we're going to be, where the Fed's mind and their head's going to be in the months ahead. That's why I think that tomorrow's data is going to be big. So what do you think about tomorrow's PPI?
Well, I want to shop at Mrs. Morrow's shop. Sounds like you're giving the best prices. You can give it a little bit of a plug there.
Exactly.
That's good. No, I mean, I think a couple of shows before I said, the market's less reluctant to move on PPI, and then and you brought it up, and then we saw a massive miss or downside surprise, and there was a bit of a move on it. So I'm not gonna go against that. But yeah, look, we're looking for 3.3% on the core PPI numbers, are slightly down. Final demand about 2.5%. And it does have bearings on corporate profitability. I mean, it has a much bigger impact on corporate profitability than CPI numbers. So in theory, it should matter, and in theory, it should actually play somewhat more of a bigger impact on markets than CPI. But obviously, the markets are so hell bent on the inflationary read and how that reads into interest rates more than the actual earnings side of things. But in theory, this has big impact on margins and corporate profitability. So I think if you see a big downside miss, then it'd be interesting to see how the dollar plays. It certainly reduces any scope for any kind of moves later in this year. I mean, the market's obviously not pricing that anyway. But it could be. I mean, the market, we need to kick some lines. But if we'd need to see an outlier move, I think we would need to see an outlier move. So, as I say, 3.3% is expected on core on year-on-year basis. So use that as a playbook. If we got somewhere close to 3% or below, I think that would potentially cause some gyrations, saying that what's going to be the PPI number on a year-on-year basis that's going to cause the dollar to rally and the market to be a bit shocked, probably 3.7%, 3.8%. So I think there's a bit of a tolerance there. So I think you bring up a good point. It's something that has missed expectations by quite some way before. Potentially it could do today, but I think that's what's going to be needed to cause to see this being the gyration effect there. Anyway,
and I was just going to say, I'm just grasping at straws right now, trying to get us out of the range, trying to find something that's going to get us out of this range, Chris.
Well, I think it's a good chance. Let's bring up that dollar chart just to show you the range that we're in at the moment. Actually, I don't have it. Sorry, it's the wrong section. I've jumped the gun.
Let's talk about the dollar.
Yeah, well, let's talk about the dollar because if we look at the daily chart of the Dixie, you are seeing a situation right now, which I won't go too much of the technicals. As I say, I've got a chart on that in a second. But the range is very, very tight at the moment. A lot of that's obviously down to the euro dollar, the euro component of the dollar index basket, 57% weighting towards that. But we failed at 111 in euro dollar, and it looks like it's going down to the double bottom target or double bottom neckline, should we say? I mean, euro's been. There's been some issues in Europe recently. I mean, you're seeing inflation expectations falling. The Citigroup economics and inflation surprise index is trending lower. I mean, going to Europe, we saw the factory orders number in Germany down 10%. The industrial production numbers down 3.4%. Yeah, it does feel like economics are starting to crack, or at least look less positive, which have been such a positive. And obviously their leverage to China is very strong. And we obviously saw the poor import number from China this week on the trade balance. So there are a few sort of worries that perhaps you've got this mixture of somewhat failing economics in Europe against this still very high inflationary environment where the ECB are still talking up rate hikes. It's sort of stagflationary environment, never good for a currency. And obviously that's a big impact on that dollar index. But how do we break it? What do we need? Do we need to see volatility in rates? Do we need to see some sort of trend in the bond market? What are you looking for?
Well, I've talked to a lot of people, Chris, regarding that are really, really bearish on the dollar. There's so many people. It's like sentiment is like overwhelmingly bearish to the dollar, and rightfully so. The dollar hasn't rallied off I think the 101 or 100.85 is like the key level of support that we're all looking at. And we haven't been able to rally even with the bank seizures that we've seen, the regional banks, and people keep citing that is like a telling tale that the dollar.
Difference. That's the difference in the smile now. Before whenever there's stress, you buy dollars. It's the opposite now. You get your money out of the US. You don't want to be leveraged to that side of things. This is quite a new phenomenon, right?
But yeah, and I hear what you're saying, Chris. But is it the real proverbial poop hitting the fan, or is it somebody just flicking a piece of crap at the fan? I mean, I don't see it being a real risk in the global economy yet. I'll say
it's not
yes.
systemic. It's not systemic. The banking situation is not systemic. It's well contained. The Fed's actions have contained it. There's a few banks which have seen incredibly big drawdowns playing through, and they've had a nice snapback, but it's still well down from the January, February highs. But it's well contained at the moment, and we are expecting further consolidation. But until we see credit markets really blowing up, spreads widening, it still feels quite contained. But that said, when we do see big moves, we haven't seen a big move for a few days now, but when we do see big moves, you do see the interest rate markets pricing that in, and we see further cuts being priced. So there is this feedback loop between the KRE ETF and higher interest rate cuts being priced in, and that subtracts from the dollar. So I think that connection is still quite real.
I do. I'm not going to disagree with you on that. And I still think the dollar looks vulnerable at this point. I'm not too sure what's going to break us out of the range. But for those people that believe the dollar is losing its safe haven status and it's not doing what it normally would do, like I said, I think you said the correct way or word to describe it, Chris. Systemic. We haven't seen systemic risk. And if we see it, and we see the credit market start to seize up, you're going to see that dollar going on a rampage.
Well,
and
it's not a credit event at the moment. I'll tell you one thing that I'm looking for. We know that the debt ceiling will be resolved. It has to be. Like, at some stage, it has to be. It's the question is there going to be a lot of pain to get to that point of agreement? It's the point of the agreement, in my opinion, unless the US has had its credit rating downgraded, and that seems unlikely. There's like the CDS market's pricing a 4 or 5% chance of that happening. But I don't think it's going to happen. I think, Biden won't let that happen. He'll change the 14th Amendment. But the moment that we see an agreement, what the Treasury do, and this is the bullish catalyst for me, is that the Treasury Department go out and issue $900 billion, $1 trillion of short-term bills, and you see a massive rebuild of the Treasury General Account. That rebuild of the General Account will take dollars out of the system. And that will be a very positive event. So the agreement, unless they've actually had a credit rating downgrade by Fitch, which are the people who have already said that any kind of issues with payments, they will downgrade them. But if we don't see that, and when we finally see an agreement, eventually that has to happen, then I think there's going to be a massive dollar rally. And that will be because dollars are being taken out of the system as the Treasury General Account will be rebuilt. So could be some downside in the short term. But when we get that agreement, I'm long dollars every day.
Well, there we go. It's interesting. Well, first of all, I like to hear you say that, not because I'm positioned long dollars. That has nothing to do with it, but decisiveness. And that
Mrs.
is what
Morrow
we need
wants
in the
to go on
market.
holiday to Mexico, and it's going to cost you a fortune.
Yeah, that's true. All right. So, hey, we're going to talk about the most legitimate and greatest central bank on the face of the planet. We're going to talk about the Bank of England right now.
Jesus, I think Michael Brown would have something to say about that. Or was that just a teaser for him?
It was a teaser, and I was trying to get a chuckle out of a few people. Actually, a few people might have chucked something at their computer screen just now. But I do want to talk about the Bank of England. Pull that guy. Where's the cane? Anyway, the Bank of England meets tomorrow morning, and they're expected to raise rates by 25 basis points, 0.25%. And people are asking, is that enough? And the vote that we're all looking for, or the market's looking for, is 7-4, 2 against. And I was talking to Mr.
Say that again.
Richard,
So 7 for 25 basis point. Yeah, and two calling for 50 basis point hikes.
Yeah, I believe so. And that's why I think the vote is going to be really important tomorrow. Because if you have the votes skewed the other direction, like let's say it was 3-6, you might see an actual rally in the sterling. Now, I know there's a lot of people, like Deutsche Bank just came out and they expect a dovish hike, and it's hard to imagine that, Chris, with CPI at 10% right now in the UK. And the food and energy costs just running rampant. I don't really understand what Andrew Bailey's his playbook is here, and I think many people will probably answer this in the comment section down below. He has no playbook, because I'd love to hear your.
It's data dependent. You make things up on the spot as you go along, don't you?
Yeah, I am. It's all data dependent, and but the data is dependent that we should be raising rates a little bit more aggressively, wouldn't you think? Anyway, here's the thing. The cable, I believe, is at a really key inflection point. If you look at the sterling, the high today was 126.80, I believe the high was. That was actually a high or a previous pivot back in 2020. I don't have the chart for you right now. Really key level. You see the euro sterling breaking down, but it's come back. It's coming back to the breakdown point. I think the pound is going to be the play of the day for any FX trader intraday. I don't have any positioning whatsoever, but I think that we're going to get some movement tomorrow morning. What's your thoughts on the Bank of England? Sorry, I ate up so much time.
No, it's cool. It's cool. Look, I agree. I mean, our clients are generally pretty short on the pound right now. They're expecting downside at these high levels at the moment. I think, I'm not going to critique that position, but I personally would, favour the pound to the downside, in my own opinion. Whether this is a dovish hike, but yeah, I mean, they're going to get 25 basis points. Every man, woman, and his dog have got that call on at the moment. Every economist, so it's fully priced into the rates market at the moment. Where I think you get conjecture is the outlook. 481 is the terminal price at the moment, which gives you 63 basis points of tights from the current level. So we get 25 basis point here. We get another one potentially in July or August. And then somewhere in September, we've got a 50-50 chance. The question is that too aggressive? And if they give off the impression they're getting closer towards an end point, but still offering them flexibility, is that rates pricing that we have too aggressive, in which case the pound has downside? So that's my theory is do we have another 63 basis points, including this 25 basis points to go? I'm not sure that the tone of the statement is necessarily going to give that. I do think the split will be 7-2. We saw that from the shadow MPC yesterday in the Times poll, and it suggests that that's going to be the case. But any changes to that could cause some sterling upside. But I think, again, we're just looking at what's priced into rates. We've got a terminal price at 481, which gives you 63 basis points from the current bank rate. And the question is will the tone of the statement suggest the urgency to get at that high? If it doesn't, sterling's going down, in my opinion. But do we play it against the dollar? The weakness we're seeing in the pound at the moment is against the Antipodeans, and certainly the Mexican sterling Mex is flying, so it's falling hard. Anyway, let's go to some of the setups. We talked a lot about the dollar. Let's go to visualize that situation. That music gets me every time. Let's bring up the NASDAQ. I actually don't have a dollar chart there at all, actually. I should have done. But we've got the NASDAQ 100. We've got the breakout here. I've talked about it before. The bull flag that we've rectified and broken out. I love that. I do like the setup. You've had the breakout. You've had consolidation. Nothing goes up forever unless you're trading cryptos. You've had this consolidation playing through. Look. It's just had it's just poked its head out. We've got a bullish outside day reversal today. I'm a buyer of strength, but I want it to just make a little bit of a higher high. So I'm using a buy stop above the market, and I'm just going to see this push through to 13,800. Take the loss pretty quickly. I just love the setup. You've got the bull flag working well. You've got price moving up, consolidates, makes a higher high, consolidates, makes a higher high. I like it. People have tried to fade this market. They tried to short it. Doesn't work. I think it goes higher, personally. That's where I see the risk.
Well, Chris, one of the things that's not drawn on your chart, if you drop a trend line across the tops, across all those highs and the wicks right there, that's going to put the top of an ascending wedge. Now, an ascending wedge, by definition, is actually a reversal pattern longer term. Now, that doesn't mean that we can't break higher, and that doesn't mean we can't continue to grind higher for quite some time. And I have to admit, the NASDAQ has been a standout index. I think you've called it really, really well, trading it long against even on a pairs trade against other indexes.
Well, I like it long at the moment against the US 30 or the Dow, effectively. So we've been looking at the Russell, long NASDAQ, short Russell. I think long NASDAQ, short US 30 or the Wall Street is probably the trade now, or you can just go generic long in my opinion. But I think playing a pairs trade is a good way. A lot of people are doing it against the Russell. A lot of big funds are saying that the best way to play an economic slowdown is long NASDAQ, short Russell, and that continues to be a fairly consensus trade. Consensus trades scare us, don't they, Blake? But this one, as you go long or do it as a long short strategy, I think works well.
I think, hey, it looks like it's breaking higher, so I think it's a good setup, and I don't think it should be faded just yet. But something that might get faded soon, let's take a look over at Bitcoin, Chris. And Bitcoin's had my attention recently. You can look at it as a head and shoulder pattern, a rounded top. I had somebody tell me today or ask, hey, Blake, is that a head and shoulder pattern? So I thought I'd throw that up there too. That wasn't my own view. But what I'm looking at is and every day I write down the same number, 26,600. Period. End of story. That is like what I like to call the line in the sand. It's the 38% retracement. It really is going to segregate the boys against the men. Just kidding. It's the bulls versus the bears. So as long as we stay above that 38% retracement, that 26,600, 700, depending on what data feed you're using, right around there, it's bullish. But if we get below that, this rounded top that we've been building it's going to break down. And then I think that we could squarely be looking at the 200-day moving average, maybe as low as like 23,900, around that 618 retracement. But it is starting to scare me, and it's starting to be one of those cracks beneath the surface that I'm seeing on risk that I think it, should, especially if you're trading long the NASDAQ, you should be paying attention to. But what are your thoughts on Bitcoin here, Chris?
Well, to be honest, we're actually seeing quite a lot of action in the smaller altcoins as well. I know there's a few that things like Pepe, everyone's sitting and going, it's broken the downtrend. You've got this really big horizontal resistance level now where it's just consolidating, certainly on an hourly chart, but everyone's looking to buy the breakout there. There's a lot of activity that started to creep up in some of the smaller altcoins, the shitcoins, if you want to call them. Just going back to your point on Bitcoin, it's interesting that, you've seen that love for the NASDAQ. But yet Bitcoin's not finding that. You've had that love in the gold price, and now it's consolidating. But Bitcoin is just getting that rounded top. So maybe people are taking their flow and trading elsewhere. But the price is the price, and that's what we react to. So it doesn't really matter what other things are doing. If you want to trade Bitcoin in isolation, if it does break that 26,623 level, I hadn't put it up myself. That I love those path patterns. I love cup and handles on the way up and reversals in that situation. I think if this breaks, it probably does have that move down to the 200-day moving average. I think the world has become, certainly from a crypto perspective, they're getting quite excited about this idea that the Fed could open the door to further easing further down the line. I think liquidity beneficiaries have done well. I think this is a good chart. This is a setup, Blake. This is a setup, and this is a setup you need to have on the radar. I want to bring the KRE ETF. Now, look at this headline that I've brought. I'm going to give myself a massive pat on the back for this one. Regional banks are cratering, ? Do you like that one?
I like that.
Yeah,
cratering.
I'm going to get a job as a headline writer for the Sun newspaper in the UK at some stage. But what we've seen is that big consolidation zone. We broke to the downside. Yeah, we've had a bit of a move up. Yeah, we're seeing in a lot of the regional banks, the outflows seem to have abated short term. The take up from the Fed's liquidity facilities, the bank term funding facility and the term discount window as well. There was a lot that was to do with FRC, it seems that it's dried up a little bit. But no one's buying these banks, Blake. The long-only funds are just not stepping in. It's just not happening. And why would you when you've got earnings mix under pressure at the moment? They've had to incentivise by increasing deposit rates at the moment. And that's hurting net interest margin. So you've got an earnings hit to this. But then the short sellers have really been going to town of late. I know there've been talk about potentially banning short sellers in banks. I don't think it's going to happen at the moment. But the level of shorts in the KRE comes to about 50% of total outstanding, including the synthetic longs, which is a massive amount of short sellers out there. But this is the perfect time for short selling. Why wouldn't you do it when you've got no buyers out there? You can just smack the price and it brings it down. So I still think this is a really interesting chart. Do we go back up into that former consolidation zone? Do we roll over? I think what happens with this ETF will have big implications for global risk assets. So what do you think?
Well, first of all, I do think it's bearish. There's no reason to be buying it. But if you went back to the last chart, Bitcoin, one of the things that have been supporting cryptos is when, banks are under pressure, people have looked to crypto as more of a safe haven type of product.
Well, I think it's the interest rate feedback, though, isn't it? It's like, banks go down, interest rate cuts get priced in because of financial stability risk. People buy crypto.
So it's like a vicious circle, right? So the flip side, and I guess the reason why I bring that up is if you do see some sort of bounce in the KRE, I think it'd be short-lived. That little yellow box that you have there, I think that's something you sell right into if you see it again. If you see it again. Did I just say that? I did say that. That's scary that I just said that. If you're a regional bank buyer. But anyway, I think that is going to be topside resistance on any rally, even if it's a little oversold right now. So speaking of something that's not oversold, Chris, I want to take you over to the Euro Yen, and I got and I'm going to talk my book really quick. I'm going to talk my book. I am short the Euro Yen as of today. And I started shorting it today or yesterday, actually last couple of days, depends on where you're at. But I've been shorting the Euro Yen. I'm going to continue to short the Euro Yen in this bear flag pattern. But today it's attacking the neckline of a head and shoulder pattern. You have two different targets there. If the flag pattern completes, it's at 145. If the head and shoulder pattern completes, it takes it all the way down to 142. At this point in time, I don't really, I'm not like favoring one pattern or the other. It depends more on risk. But I do like the euro yen to the downside, especially if the euro dollar starts failing below 109.40, which is key support on the euro dollar.
What do you think about that divergence, though? You see the divergence play. Is that divergence because the left-hand leg of that last RSI is so low that it hasn't managed to get down? Does that worry you at all for a bounce?
No, because I still think that RSI it's still being written. So if we continue to break lower, that's going to be a positive or a not non-divergent. It's going to be a confirming RSI. So I don't think the downside's done yet, but we get oversold, then you just start selling rallies. But this is a core position I plan on working for a while we're below the level that I'm looking at. Let me just pull it up for you really quick on my end, just so I can give you the number. As long as we stay somewhere below like the 147.50, I'm just going to continue to chip this away on the short end. What are your thoughts on the euro yen? Sorry, I chewed up more time.
No, that's all right, mate. We're going over. We're going over today. It's fine. We've got a lot to say. It's good. I like it. The world's been pretty bullish on euro for obvious reasons. Natural gas prices. Better economics, less bad situations. But we're starting to see a little bit of fragility going into the investment case for euros. I know real money are pretty short on euros at the moment, probably from more of a portfolio effect, but the leveraged accounts are still slightly long on euro. And that means from a positioning perspective, there's still a lot to go. We know that the world's been pretty short on yen for obvious reasons. They've had to push back on their review, and people were all saying that they were going to move on yield curve control and that target in June. Now that's been pushed back later on, and so that's weakened the yen off. But I like this. I mean, I can make an investment cut. I can make a trade case from a fundamental perspective why it would go down to those targets you talk about. As I talked about, inflation's high, but it's too high when economics are starting to show some vulnerabilities at the moment. So I like it lower. And I'd probably be looking. I'm not going to work it like you are, but I'm. But I'm not going to work it like that. But I'd certainly look at it for a trade on the breakdown there as well. Anyway, let's go to the section we all love: Play of the Day. Okay, let's have a look at the Euro Aussie. Now, I've been pretty bullish on Sterling Aussie, and that trade's come under a halt now. Sterling Aussie, Euro Aussie, they've started to show cracks. So what we've got here is a regression channel. So it's really just looking at something more on a statistical basis. You've just got that line of best fit that goes through and two and a half standard deviations either side of that section. And it's been responding and respecting that really, really well. Now, what we've seen is a breakdown through there. We're testing horizontal support levels at the moment. And you can see that doji on the daily chart there. Well, now, the way I want to play this is just use that momentum. I've got a sell stop order below the low. I just want to wait for it to just come crashing down, and I want to ride that lower. We've got a couple of levels on the downside that we're looking at. But I'm looking for sell stop orders in this situation. Now, the thing is, as I talked about with euro, factory orders getting weaker, industrial production numbers getting weaker. They've got high inflation, which still means that they're going to raise rates, but it's largely discounted into the price. On the other side of the equation, we've seen the Aussie budget, not something that people really trade on, but it's expansionary. It's going to be disinflationary this year, but it will increase to greater growth in the years ahead. I'm still a believer in China. And if actually look at the trade import numbers, while they're weak for most countries, actually still pretty strong for Australia. So I like the trade lower, but I want to just wait for that momentum, break through the lows, and try and ride it lower. So I'm just not in the trade now. Just a bit. A weakness manifests into further weakness in this trade for me.
All right. Well, Chris, I'm gonna take you over to the U.S. dollar, South African rand, and this is a title that I used before during It's a Setup like a few months ago, and I said, "ZAR she blows." The ZAR she blows again. Well, we have a cup and handle pattern, and the breakout actually happened today. Now, if you look at the longer term charts, it actually points a lot higher than 1960, but 1960 would be the measured move of the cup and handle target. Now, we broke out today. There's some risk, macro risk because of load shedding. There's an energy problem that South Africa is having, but also, if the markets get a little wobbly, you might see some covering up of some dollar rand positioning as well, because that's a really big FX carry trade for a lot of institutional traders, and it's going the wrong direction. If you look at the dollar MEX, that's going the right direction. Yeah. Dollar rand is going the wrong direction.
Go and pull up a chart of the Mexican versus the SAFA.
Oh, gosh.
If I could be a chart, I'd be that chart. I'm not, obviously. I'm far from that chart, but I'd like to be that chart.
That would be a good chart to be. But anyway, I like the US dollar South African rand. I bought it today personally. I'm buying dips. It costs a little bit to carry, so you don't want to hang on to it too long, but upside targets are within view. So I like the breakout.
I like it too, mate. And do you know what? The South African rand's been getting badly beaten up when the MEX is flying. The Aussie's doing quite well. The MEX, all the high beta FX plays are doing quite well. But the South African's not working in this market. Obviously, there's news associated with that situation at the moment. But I like that setup. I'm actually going to substitute my trade idea. I'm still going to trade my trade idea, but I like your one. I think everyone's going to back Mr. Morrow for his play of the day today. Anyway, that's all we've got time for. If you've stayed on this long, we really appreciate it. Smash the like button, kick the absolute bejesus out of it, and give us a comment about how you're trading the market, and we'll try and get to it when we can. We'll see you next week for more of the Trade Off.